Index funds are one of the easiest yet most powerful investments that nearly anyone can use to build wealth over time. In fact, the creation of the index fund is widely regarded as one of the most successful innovations in modern financial history, where the benefits of passive investing have become increasingly clear over time. And with their significant growth in popularity, they have just recently passed the amount of assets in actively managed funds for the first time in history. Not only does that sound assuring, but one of the best investors of all time, Warren Buffett, says that by periodically investing in an index fund, the know-nothing investors can actually outperform most investment professionals. With that said, my name's Sully, and all I ask is that if you do find value in this content, that you consider hitting the like and subscribe button with notifications on for future content like this. Now, I'll have timestamps created in the description below for you if you want to skip around, but to get straight to it, let's first go over what exactly is an index fund. Because this term may seem confusing, especially for beginners, think of an index fund as a collection of different items on a list that you can put your money into, and in return, that would allow you to own all of those items within that list, all within one purchase. A real-world example I love referring to here that can relate to nearly anyone watching this is when you go shopping for groceries, and when you finish buying them, you end up getting a receipt. That receipt has a list of all the items you just bought, and what's likely to happen is you are going to have different prices for every item. So chicken might be $15, rice might be $5, and bananas might be $3, and so on. But notice how the price for all those items comes down to one single price that you pay all at once at the end, and let's say that's $100. The reason this is a thing that everyone does is because you don't want to go to the grocery store and buy 50 items separately and get 50 different receipts, and you also don't want to go and spend $100 of your money on only bananas. That is, unless you have a bunch of monkeys to feed. But all in all, the idea here is that you would ideally want a variety of foods and drinks to choose from. So the reason I love this concept is because it is very similar to how index funds work, but rather than foods and drinks, index funds offer a variety of investments, typically stocks or bonds. And so when it comes down to investing your money, you don't want to go through the process of buying 50 separate stocks, and you also don't want to put 100% of your money into one individual stock. The idea here is that with index funds, you want a variety of different stocks and bonds that maximize your returns, yet minimize the risk of losing money. And what's amazing here is that with the right index funds, you can have your money actually work for you and grow significantly over time. Where one of the most popular index funds you need to know about is the S&P 500 that allows you to gain access to 500 of the largest publicly traded companies that are listed here on United States exchanges, where the S&P 500 is typically referred to as the US stock market benchmark, providing a broad scope on how the US economy is doing. So if you decide to buy an S&P 500 index fund, you are able to gain exposure to top companies like Apple, Microsoft, and Nvidia, all within one purchase, so you don't have to waste your time buying 500 companies separately, and you also get to reduce significant risk on your savings because now you're invested into 500 companies rather than putting all your money in one stock. And just like getting a grocery bill where there's many different stores you could choose from to get your groceries, with an index fund, you may be able to buy them through many different providers. And so one of the most popular ones when it comes to buying an S&P 500 index fund is from Vanguard, that is the Vanguard S&P 500 ETF, with the ticker VOO. But one of the best perks about index fund investing is that there are many different types of markets that you could invest into. So let's say you want to gain exposure to some of the top companies that are listed outside of the United States. You could invest into an international fund, where a popular one here is Vanguard's Total International Stock ETF with the ticker VXUS. Or let's say that you want more exposure to the United States than just the 500 companies in the S&P 500. You could simply invest into nearly the entire US market through the Vanguard Total Stock Market ETF with the ticker VTI. I'll cover more on the best index funds to consider later in the video, but understand that there are actually two types of index funds that you could purchase. One is an ETF, like the S&P 500, that has the ticker of VOO, and then the other could be a mutual fund, and Vanguard also offers this, where it is traded under the ticker of VFIAX. Because I know how confusing this may seem, to break down the main differences, if you invest in an index mutual fund like VFIAX, index, understand that it is going to be less liquid because the trades when you go to buy or sell them only go through at the end of the market day, so it's once per day. There may even be a minimum investment amount required. You typically have to buy them through particular brokerages. Most have 5 letters in their ticker symbol, such as VFIAX, and they are known to be less tax efficient, especially actively managed ones, but more on that later. Where with an index ETF like VOO, these have become increasingly popular over the recent years because they're very liquid, as they trade the exact same way as individual stocks, so you can buy or sell them throughout the day. There's no account minimums required. You can buy them on any investing platform because they are listed on stock exchanges, which is exactly why the term ETF stands for an exchange traded fund. Not to mention, but they typically have 3 to 4 letters in their ticker symbol like VOO, and they are known to be more tax efficient than mutual funds. Now, if you are confused and want to learn more, I'll have 2 videos I recently created that I think you could greatly benefit from, and I'll have those linked in the description below for you to check out after this video. And so knowing that, let's now go over why to invest in index funds. For starters, understand that the word index refers to a list of something, and fund resembles the ability for you to purchase that index. For this case, the ability for you to invest in different market segments. And so the benefit here is that index funds are passively managed, which means they are created and managed based on strict guidelines. For instance, in order for a company to be included in the S&P 500, a company must meet certain requirements, including the company to have a specific market cap of at least $14.5 billion, have a majority of its shares in public hands, and it must be a publicly traded company for at least a year. There are many more guidelines that we could discuss, but the key takeaway here is that because index funds are passively managed, they're super cheap to operate, and because of that, for investors, they're typically super cheap to own. And so the cost it takes to own a fund per year is called the expense ratio, where for the S&P 500 ETF VOO, it is reported to be 0.03%. All this means is that every year you invest $10,000 into this fund, you will be charged $3 per year in fees. And do know that these fees will be automatically taken out of your investment over time. It's not something you're going to have to pay separately. But understanding the importance of this alone is crucial, because if you invested into actively managed funds, ones that are created and managed by experts, or also called fund managers, these are typically going to be much higher in an expense and can significantly eat away at your portfolio. In fact, Charles Schwab states that the average passively managed fund has an expense ratio of 0.05%, where their average actively managed fund has a 0.76% annual expense. Crazy enough, if you invest $1,000 per month into the average stock market return and do it consistently for 30 years into the average passively managed fund with a 0.05% expense ratio, then that means you would end with close to a $2 million portfolio and a total cost of around $18,000. Where if you instead invested into the average actively managed fund at 0.76%, then your end portfolio would be around $1.7 million, which is lower because you would have accumulated a total cost of $263,000 in fees from owning the fund. That's close to $250,000 more throughout the time of your career, all because you are now aware, which if you are finding value in this content, all I ask is that you consider hitting the like and subscribe button with notifications on for future content like this. And not just can you save a ton of money from fees with index funds, but the S&P Dow Jones indices reported that 89.5% of all large cap actively managed funds have underperformed the S&P 500. Now remember, these actively managed funds are controlled by people with extremely high levels of education and competitive careers that spend all of their time optimizing investment portfolios, and yet 90% of them underperform the returns of a random person on the street who only bought the S&P 500. So not only can you save money from fees over time, but you are also much more likely to grow your money stronger, where the best statistic I like referring to here is from the S&P 500 that shows the average annualized returns since 1928 are just over 10%, which is what I just used in the previous calculation. Aside from that, when you invest in index funds, you are also able to have great diversification among your portfolio, where for instance, let's say you have $10,000 and you just bought 2 stocks, that'd be $5,000 in each. If one of the companies went bankrupt and their stock price went down to 0, and the other one, let's just say, stayed the same, that means your total portfolio would now be worth $5,000 instead of $10,000. But if you invested all $10,000 into the S&P 500 that has 500 companies all within one purchase, if one of those companies went bankrupt, then your portfolio would only decline to $9,980, and more than likely, you wouldn't even notice the difference. I've also learned from personal experiences how difficult it is to pick the right stocks and try to outperform the market, where one of my favorite quotes here is from the legendary investor Ray Dalio, where he said, "Trying to time the stock market is harder than competing in the Olympics." And lastly, with the right index funds and enough discipline to hold them long term, you can in fact see great returns over time, which has allowed many people, no matter their income levels, to retire successfully. Knowing that, let's now go over the best index funds to consider. Now, you could really narrow down the type of index fund that you want, but to keep things broad, the first I'll mention here is a domestic fund, which for me, being in the United States, this means the fund contains only US stocks. And so the first one I'll mention is the S&P 500, and the one through Vanguard is VOO, that is currently ranked number 1 as the highest ETF with assets under their management. And so to summarize the key points on this fund, as I mentioned, it tracks 500 of the largest US-based companies, which it's super cheap to own with a 0.03% expense ratio, and over the past 10 years, it has averaged a 12.27% annual return. Besides that, another domestic fund to consider is a total stock market index fund, where the number 4 on the ranked list by assets under their management is VTI, where it currently has 3,598 different stocks, with top sectors being technology, consumer discretionary, industrials, financials, and healthcare, where VTI has a total expense ratio of 0.03%, and over the past 10 years, it has averaged an 11.61% annual return. Also, just be aware that these are some of the most popular ones that you could consider, but with these ETFs in particular, they have an overlap of 88% with each other, and because of that, you may want to pick one over the other. Aside from that, another domestic fund that has done very well recently is a large cap growth fund, such as Vanguard's growth ETF with the ticker VUG, where this fund has only 166 stocks that are tailored toward large cap growth companies, with its largest sector being technology at 57%, coming from top companies like Apple, Microsoft, and Nvidia that make up roughly 30% of the entire fund. Which, not to mention, but this fund has a 0.04% expense ratio, and over the past 10 years, it has averaged a 14.45% annual return. So with an investment like this, the risk is slightly higher, but that also comes with the potential of slightly higher returns. Besides domestic stock, another asset type to consider is international stock, where a popular one here is the Vanguard Total International Stock ETF with the ticker VXUS. This fund currently has 8,602 stocks that come from emerging and developed markets that are outside of the United States, with its top holdings being Taiwan Semiconductors at 2% of the weight, with many more thereafter. Now, this fund has a 0.05% expense ratio, and over the past 10 years, it has averaged lower returns than US stocks, being 5.02% of an annual return. And the last investment I'll touch on here is a bond fund, where one of the most popular ones is also through Vanguard Total Bond Market ETF with the ticker BND. Now, as you can see, BND has 11,379 different bonds, with its average duration being 5.9 years, with the majority coming from US government bonds. The income payments here are paid on a monthly basis, where it costs 0.03% per year to own BND, and over the past 10 years, including dividends being reinvested into the fund, BND has averaged a 1.53% annual return. Personally, if you need to store cash away for quite some time and you know this ahead, I would personally prefer to build a ladder with individual bonds to ensure that you are getting a fixed income over a particular period of time, no matter what. But now that you know some of the most popular index funds to consider, let's now go over how to buy index funds. For starters, let's say you want to buy the S&P 500 Index ETF with the ticker of VOO. You can buy this on nearly any platform that you invest on, and the process is going to be very similar no matter the platform. Now, for this example, I'm going to be using Fidelity. I'm not affiliated with them. I just really like their platform display, overall features, and I've been using them for quite some time. And so to get started from here, for most investment accounts, you'll typically see a search bar on the top where you can type in the investment that you are specifically looking for this case, VOO, and from there it will take you to a page to learn more about the investment. From there, if you want to buy VOO, you're going to simply click buy and then you'll either be sent to a new page or have a screen pop up like this, where you can then make sure you have the right account that you want to use, type in the amount that you want to purchase, which Fidelity also has a little calculator tool where you can input the exact dollar amount you want to invest, where they allow you to buy fractional shares. Many brokerages nowadays allow fractional shares on ETFs, and once you see the right amount that you want to buy, let's just say 2 shares for this example, you can see the estimated value you're expected to buy. From there, click preview order, and if everything looks good from there, you can submit the order to officially buy VOO. Where if you were to submit the order when the market is closed, the purchase would go through right away when the market opens. Now, if you already own the fund and you want to sell it, the process is the exact same, but now you would click on sell and input the right information based on what you want to be done. So now that you know how to buy an index fund, let's now go over how much to invest. Now, I'm not a financial advisor and you have to make your own financial decisions, but as simple as what I'm about to say may sound, this simple and boring approach is actually what has worked best based on the historical facts. And so what is calculated is that if you invest $19 per day, which is $6,935 per year, and you achieve the average stock market return, let's say with an ETF like VOO or VTI, that's around 10%, not including inflation, but that means if you did this for 30 years consistently, that you will have a portfolio worth over $1 million. And the reason I computed these specific numbers is because the max contribution limit within a Roth IRA is $7,000 per year as of 2025, and if you're over 50, you can do an extra $1,000. But the reason I highly recommend this for everyone watching is because after all the years of compounding the growth on your investments, when you're invested in a Roth, once you reach the eligible age at retirement, you can withdraw anything you want out of the account completely tax-free. And remember, volatility should not matter within your Roth IRA because you need to view this account as something you literally don't touch until you're at retirement. With that in mind, investing in growth in your early years will help you even more, but from the example, by the time you are 60, that would end up being $1.1 million completely tax-free. And because of what's called compound interest, which means the growth on your investments continue to grow larger and larger over time, if you started at age 20, by the time that you are 60, you could have a $3 million tax-free Roth IRA. And that is all from investing $19 per day into the average stock market. And no matter what age you start, don't forget that over time, as inflation rises, on average, so does your income, and the contribution limits that you are able to put in to the Roth IRA also increase over time, as well as that extra $1,000 you can do once you're in your 50s. So there are many great ways that you could potentially even boost your potential even more. Now, if you're brand new to my channel, I made many videos related to this type of content, such as the optimal order to invest your money, why the S&P 500 is such a strong investment, understanding if you would rather invest into VOO or VTI, or even the 5 best ways to invest in taxable accounts. That are just a few of the videos that I've recently created that I'll have linked in the description below. And don't forget, the simple approach may actually be the best thing for your financial future, and whatever you are confident with, stick with it and stay disciplined to the plan, because the reward can take some time to see, but with the right investments, it is well worth it. Now, if you want to learn more about building your own portfolio, I'll leave a free guide that includes my own template that you can copy and use for yourself, which I'll have linked in the description below, as well as many other free learning guides that I've created. Now, if you have any questions or requests, let me know in the comment section below. And if you want to get started on a new investing platform, I'll have a direct link below to some of my favorite ones that I personally recommend. End of the day, I want you to do what's best for your finances, but do know that depending on the one you choose, I may earn a commission for it, which is greatly appreciated. And as always, don't forget to hit the like, subscribe, and notifications button for future content like this.